Hello, everyone. Welcome to this educational program organized by the Association of Foreign Press Correspondents in the United States. Today, we are going to dive into the discussion, did too much faith in free markets and do globalization? That's the question at the center of a new white paper by Stuart Patterson. Our guest today, you're already here with us, a research fellow at the Hinrich Foundation. It offers a thought-provoking exploration of the forces that are unpacking global trade dynamics. I'm Patricia Vasconcelos, a board member of the Association of Foreign Press Correspondents in United States. After our brief introduction, we are going to open this panel for questions. So each of you that are here online with us, please feel free to drop your questions. Stuart Patterson spent 25 years in capital markets as an equity researcher, a strategist, and fund manager. He has worked in London, Mumbai, Hong Kong, and Singapore in senior roles with Credit Suisse First Boston, CLSA, and more recently as a partner and portfolio manager of Tiburon Partners, LLP. Having started his career with Hill Salmon in London in 1991, he has covered the full spectrum of global markets equity strategy, developed markets equities, and emerging markets equities, and he has seen firsthand the financial system. In 2007, he co-founded Whitley Patterson Investment Management in Singapore, where he ran a macro-driven hedge fund that exploited the abnormalities in capital markets being created by globalization and existing monetary order. Stuart has a deep interest in assisting readers to understand the impact of macroeconomics on trade, geopolitics, and prosperity, using his 30 years of professional experience in global capital markets from a front row seat during the Asia economic miracle, the emergence of China, the Asian financial crisis, the tech bubble, and the global financial crisis. He aims to provide practical insights into the historical and potential impacts of past and current macroeconomic events and its policies. He holds an MA degree in economics from the University of Aberdeen, and this program is organized in partnership with Hinrich Foundation. So, Stuart, thank you very much for joining us today. Welcome. And please start with your briefing, anything you would like to say about your paper. Thank you very much. Welcome.
Thank you, Patricia. I think maybe I should start just by putting this paper in context. It's part of a series. It's the third in a series of 4 papers that's looking at what has gone wrong with globalization, and how to put it back together in perhaps a more sustainable way. And the first of these papers, which is available to anyone on the Hinrich Foundation website free of charge, really went out to emphasize the uniqueness of the period or of the late 20th and early 21st centuries from a holistic point of view. Because that period of globalization took place against a backdrop really of 4 factors that I think are very abnormal. The first was that we had, a sole global hegemon in this case, the United States, that was prepared to oversee a multilateral system and support a multilateral system and give up a lot of the negotiating power that naturally accrues to an economy of its dominance in bilateral relationships. And clearly that was an important driver of the multilateral system, facilitator of it. And during certainly the first decade of the 21st century, there was no great power rivalry to speak of, which meant that the international dimension to economics, trade and overseas investment and what have you, was taking place in a geopolitical vacuum, or at least that's what the participants thought at the time. And trade was also unpoliticized. There was no attempt, or very little attempt, to conflate trade deals or trade negotiations with extraneous factors such as environmental agendas or human rights agendas or what have you. And so those three factors, I think, were very important in driving globalization forward. And the fourth of those factors was this unchallenged dominance, really, of a neoliberal economic philosophy, and tremendous faith in the power of free markets to produce, if not perfect solutions, certainly better solutions than governments could hope to engineer. And with that dominance of a political theory came prescriptions, policy prescriptions, perhaps best encapsulated in the term Washington consensus, although Washington consensus and neoliberalism should not be confused to being synonymous, but clearly the Washington consensus had very deep sort of classical liberal foundations in it. And for the benefit of our listeners who are perhaps unfamiliar with that, I mean, it basically elevated markets in the sense of, the prescription was that you should be fiscally prudent, that exchange rates should be flexible, keeping tight control of inflation was important. And so that sort of market-orientated, laissez-faire approach was dominant, certainly prior to the global financial crisis. But it also, I would argue, in some ways, was the undoing of the globalization process as it was then thought of. For a number of reasons. I mean, firstly, it was thought of as being so compelling and so commonsensical that no one would turn their backs on it. And clearly, the rise of China adopting policies that were anything but liberal posed a challenge in and of itself. The relative success of China. And we'll talk a little bit in a bit more detail about that. But the other issue, I think, was that clearly a lot of the mechanisms, the market mechanisms that were supposed to produce some sort of equity and justice in outcomes did not come to fruition. And China was able to prevent them from working, really, through its economic model. So just turning back a little bit to China's growth, I mean, clearly China did embrace in the early part of its reform program some of the characteristics of a market economy, but it was never a market economy or even really a mixed economy. The export sector, which was largely private sector owned and competed in the global marketplace, was serving the purposes of the party state in earning dollars, which China desperately needed. And therefore, what China was really doing was harnessing some of the incentive structures of a market economy, but it was never trying to emulate the economic structure of a market economy. Industrial subsidies were very heavy. There's plenty of, there are plenty of studies out there. The data is hard to get, but most people would agree that China's industrial subsidies are maybe 4 times as large as the largest OECD subsidizing countries as a percentage of GDP. The state allocated capital and continues to do so. So, the banking system is the primary way in which China's savings are intermediated, and the state banks dominate the banking sector. Capital controls mean that China's savings pool is internalized, and where it does need to be recycled out of the country, it is done so in a fashion that is in keeping with China's wishes, state wishes. And obviously the whole planning process from the central plan down to industry level plans mean that it was never a market economy, and even less so now. And so I think what the proponents of free market liberalism, or at least those who believe that a market-orientated economy could operate in conjunction with a planned economy got wrong, really twofold. One is, China did not become more like a market economy as time progressed and the society became more affluent. But secondly, they underestimated the ability of a planned economy to actually change the market economy and to disrupt markets. And in the paper, I go into sort of a couple of areas in which this has become very evident. So clearly, when it comes to trade, one of the most important things is that over time, trade patterns show a tendency towards equilibrium. It's not the same thing as saying that, every country needs to run a zero trade balance every year. Not at all, far from it. And there are sometimes very good reasons why, for reasonably prolonged periods of time, countries might run a deficit or a surplus on their current accounts. And those are quite legitimate, but there is meant to be an adjustment mechanism in place. And the idea is obviously that, if a country is gaining an advantage because the price level in that country is particularly low, there will be a tendency for the net buying of that currency to drive the exchange rate up. And therefore, over time, the price arbitrage will disappear. And that's best encapsulated in the sort of theory of purchasing power parity. And what the paper does is just look at the last 40 or 50 years or so, and is there any tendency for currencies to trend towards purchasing power parity? And the numbers are very stark in the sense that there isn't. And there's a chart in the paper that shows world GDP in purchasing power parity terms relative to world GDP in nominal US dollar terms. And obviously, if there was a tendency for the two to converge, that would show that over time there's a tendency for purchasing power parity currencies to move towards purchasing power parity. What it actually shows is that as we speak now, the gap between the two in percentage terms is as large as it's been since 1990. So there has been no adjustment mechanism through real effective exchange rate movements. And that manifests itself in another factor, which has been simply there has been no tendency towards balance of payments equilibrium either. That China has run a trade surplus every year since 1993, and those trade surpluses are growing again relative to GDP. So the faith in the adjustment mechanism, I think, was ill-founded. And the other issue, and this will have occurred to some of your listeners, is that obviously, where countries fix their exchange rates, obviously, that adjustment mechanism can't work in the short run. But in theory, that's just meant to delay it somewhat, because what then happens is that inflation differentials adjust the real exchange rate in order to produce equilibrium outcomes. And what you have seen, of course, is that, yes, the net buying of the RMB, as it were, that was a natural consequence of those large current account surpluses, did produce huge monetary growth in China, extraordinary monetary growth in China. But that did not translate through into rising prices in the quantity that theory would suggest that it should have done. And that's because the velocity of money in China has not been constant, nor has it been in the rest of the world, but it's fallen even quicker in the rest of the world, in China, than it did in the rest of the world. So the sort of natural mechanism for bringing about equilibrium in the external accounts in a fixed exchange rate environment didn't work either. And so that should really, I think, lead us to focus on the idiosyncrasies of the Chinese economic model that we've explored at the Hinrich Foundation in detail elsewhere, and to ask whether this economic model is actually compatible with an equitable and sustainable global trading system. And really, I think the answer that the paper is building up to here is that it isn't, and that whether one wishes to apportion all the blame to China or whether you wish to apportion some of the blame to the people who misread what would happen in the eventuality of China growing as rapidly as it has and becoming as significant as it has on the global trading system is somewhat a moot point, because where we arrive at now is that the global trading system is looking extremely fragile and falling apart, and there's a requirement to try and rectify it. And so that's really where I think this paper takes us, and the final one in the series will look at the various options open to those who are interested in trying to preserve a multilateral trading system, and what those might be moving forward.
Well, thank you. You already spoke at the beginning about you gave us already an overview of some factors that facilitated globalization in the late 20th and first 21st century. But from those factors you pointed out already, each one that it could highlight for us, lack of politicization, for example, if you could please give an overview about those factors that facilitated globalization in the past.
Yeah, so when one looks at the period in which trade relative to GDP rose very rapidly and FDI rose very rapidly, this was a period in which there was a very conscious effort in the World Trade Organization and others not to conflate various political factors with trade agreements. There was never really any human rights threshold to joining the World Trade Organization. What was required was adherence to the principles of the World Trade Organization, not any kind of extraneous political agenda. But obviously, in recent years, we've seen human rights become more of an issue in people's minds as to, and it's been in many ways customer-led, that people want to know that the products they're buying have been made in a certain way or have adhered to certain standards. But we're also now faced, obviously, with the environmental agenda, and people want to know not only at the customer level but at the government level, how much carbon has been produced in the manufacture of a potential import or to a country, and so this is going to add a whole new level of complexity to the global trading system. And we're the European Union at the moment are in the sort of experimental phase of their carbon border adjustment mechanism, which they've gone to great lengths to try and ensure is World Trade Organization compliant, although that's yet to be tested, and I would imagine it might well be tested, the compliance of it with the underlying principles of the World Trade Organization. But they will not be alone. They're just perhaps a little ahead of the curve in this in some ways, and so clearly I could see it's not very difficult to imagine how this is going to introduce a level of complexity into trade agreements and trade friction. It's going to lead to accusations of protectionism, and further potential fragmentation and breakdown of the trading system. So the absence of that was clearly a great facilitator.
Interesting, because you just said about topics that it's right connected with trade and everything that we journalists deal in a daily basis while covering our stories, right? Human rights, environmental agenda, and how this impacts trade. And how has the rise of China changed that?
I think it's trade changed everything in the sense that China's got a questionable human rights record. It's got a questionable environmental record, but more fundamental to the old trading system is that the exporting success of China has been achieved through enormous state promotion efforts, and the asymmetric nature of market access has clearly been a cause of iniquity in the global trading system amongst the global community. The question, I suppose, that comes from that, if you accept that, is that is this a function of the rules, that the rules weren't up to the job because the World Trade Organization was not designed to deal with the sort of mercantilist command economy? Or is it actually the responsibility of China's trading partners to have held them to account at the WTO, and that actually the mechanisms are there or were there in order for people to hold them to account? And I think there's an element of truth in each argument, but clearly the WTO works on trust up to a large degree. I mean, things like the national security exemption, for example, can be construed as a get-out clause to almost anything. So members trust each other to use it discerningly. I think clearly the rise of China has led to a breakdown of that trust. The remedies are slow in coming, and arguably insufficient to have modified China's behavior. Because what one has to bear in mind is that clearly that China is not sort of moving to meet the free trade norm. It's moving away from it. And therefore, whoever's responsibility it is, or wherever the fault lies, whether it's the rules or the people who are responsible for holding people account to the rules, clearly it's not worked. And that is a cause of great concern. And I think that's why, multilateralism, if it's going to exist, has to be perhaps less inclusive. And that, it's not there for everyone, because the trust won't be there between everyone. And clearly, I think you've seen that up to a point in terms of the proliferation of bilateral agreements, the proliferation of plurilateral agreements. In the case of Europe, for example, the development of the single market has meant that, the EU has become quite an insular, when it comes to trade, quite an insular economic bloc. Clearly, the United States trades massively disproportionately with Mexico and Canada. It's NAFTA partners. One would imagine that CPTPP has the potential to be a slightly more inclusive but not all-encompassing multilateral forum in which trade can progress, trade deregulation can progress forward.
Mm-hmm. Some very interesting thoughts you just put here. I just would like to follow up a little bit. For example, as you said, China does not meet the rules established. You also talk about the lack of trust, and because of that, the multilateralism that we are seeing must be less inclusive. Should we change the word then? Because I understand multilateralism should mean the opposite.
Yeah. So the issue I think here is, if we are arriving at the conclusion that it is really the participation of one large economy in the global trading system that has led to it breaking down, is the way to preserve the vast majority of the benefits of trade, to exclude that country from the World Trade Organization. And if that cannot be done, will other forums start to emerge, CPTPP potentially being one, in which those countries that actually are interested in deepening trade relationships along market-orientated lines, and using best practice, are prepared to push ahead further. And WTO existed, of course, for many years and gap before it, without China being a member of it, and was still considered a multilateral organization, and arguably, was functioning better than it does now, if not perfectly. And so, I certainly think that that is an option that should not be ruled out. And whether that means WTO changes or whether it means simply WTO gets more irrelevant because the other forums start to grow in significance.
Well, also in your paper, you argue that one of the impacts of the increased importance of China is calling into question the superiority of the neoliberal model in delivering a sustainable path to development. Could you give us an example of what led many to think to this thought, questioning the security or the stability of neoliberalism?
Yeah. So I mean, I think if you look at China's success, and it would be churlish to argue that China hasn't had a modicum of economic success over the last 30 or 40 years. China has taken, its per capita GDP, from $1,000 when it joined the WTO pretty much to $10,000 now. And that is, roughly speaking, the global average. So China has gone from being a very poor nation to being an average nation in world per capita GDP terms. And that's a formidable achievement, to be fair. Other countries that have had similar success or more significant success than that, such as Japan and South Korea, Taiwan, Singapore, etc., have all themselves at times adopted a sort of mercantilist approach to development. It's just that at various points in time, they moved away from that because they saw that that model had taken them as far as it could go. And, broadly speaking, there's been a lot of pain in doing so for a period. South Korea, the real break with that was the Asia financial crisis. Japan, of course, with the Plaza Accord and then the bursting of the Japanese bubble in 1989, went through a very painful adjustment process. And I think the lesson to be learnt from those examples is really that the longer you allow this unsustainable model to roll on, the more painful it is to adjust to a more market-driven model that can take you to the next level. But you do move on once you abandon the mercantilism. So China, I think, has outgrown its model. Its model is broken. And I would divide its development model into really two phases. One was the export-orientated, heavily export-orientated period up through the global financial crisis, and then the domestic investment-led model post that. And what you see in the falling returns on the incremental returns on capital employed in China, the massive over and bad investment that's taking place, and the poor returns for growth that you're getting on that investment, I think is showing that model has sort of run its course. And therefore, there is some cause for hope that with the right leadership, China might adopt a more liberal economic model that would be more compatible with its external economic relations and some sort of equity and sustainability in those relationships. But at the moment, there is no sign that the current leadership is leading us in that direction.
Interesting. And let's go to another part of your paper. In the re-emerge of mercantilism, you argue something interesting, at least from my point of view, and also important, that China's obsession with excess saving builds foreign exchange reserves far in exceeds of those needed for precautionary reasons. And then China uses this to invest in geopolitically overseas assets. How is this method different from what it's done in the West?
Sure. So let me just, first of all, just go through the logic chain there for those who don't necessarily follow it. So when you run a current account surplus, there is net buying potentially of your currency, and you have to export capital back, right? And your current account surplus is a relationship between the level of investment minus saving in your domestic economy. So because China invests an awful lot in its domestic economy, but it saves even more, which is another way of saying it consumes even less, right? So China has to export, has to be a net exporter of capital because it is a net exporter of goods, basically. Okay, and what happens is that that net buying of your currency, the PBOC soak that up in the market, and then historically they bought foreign exchange reserves, and then they more recently, basically since BRI came into existence, those dollars have actually been recycled out of the country through development banks such as China Development Bank or the Export-Import Bank, as well as some of the state-owned commercial banks, or CIC, or institutions, state-controlled institutions that have been put in place for the purposes of BRI and overseeing China's external assets. And obviously buying US treasuries brought very little geopolitical influence, and arguably was a bad commercial decision too, because at the time they were yielding very little, and they weren't without their risks, especially when they moved into agency debt, and some of that came home to roost arguably in the global financial crisis. So you could argue there was something of an economic rationale behind diversifying away from just the foreign exchange, the traditional foreign exchange reserves, into other assets. But the fact that all those assets really are owned by, or the vast majority are owned by, state-controlled entities, is the big difference between the internationalization of China's balance sheet and the internationalization of anyone else's balance sheet really around the world. Obviously there are sovereign wealth funds in the oil-rich states and Singapore and what have you, but I'm talking about the major economies around the world. The other big difference, of course, between China and the United States and the United Kingdom in particular is, of course, the US and the UK run big current account deficits, which means that they actually have to import savings from other people on a net basis. So they are, in fact, at the other end of the spectrum. When the United States or the UK give overseas aid, they have to fund that by selling domestic assets in addition to the current account surplus. So the West, or large parts of the West, obviously Germany would be in a different situation, Japan has been in a different situation in the past, but large parts of the West are actually current account deficits. They're therefore savings deficit countries, and so we're in a very different situation.
Let's go to another part of your paper before we open for questions from our audience. You also dive and explain the copycat mechanism, right? Copying other mechanisms here in the US regarding the China. And you leave a question there, 2 questions. Is the only way forward? Do we have a better way? Do we have an answer for that?
Well, I think that
trying to do the same.
Yeah, the final paper in the series will help address that. But I think, what we're finding here is that as a result of China's mercantilism, the concentration of manufacturing capacity in China that has come with those industrial subsidies and the undervalued exchange rate, as well as, of course, the hard work of the Chinese people. It isn't just down to those policies, but you've in a world of great power competition, suddenly supply chain resilience and the availability of goods has shot up government agendas, right? So people are now worried about the weaponization of trade, and the potential for economic coercion from China, and so they're now much more concerned about where these trade dependencies lie. And the knee-jerk reaction is to say, well, we must make these things ourselves. And, that's going to be expensive in terms of taxpayer money, but, it's going to be worth it because it improves resilience. I suppose the question, is there another way? What I'm alluding to there is that, if everyone sets out to be autarkic and self-sufficient in everything that they deem important, then the world's going to become a much poorer place very quickly. The solution to resilience and security in supply chains is diversification as much as it is as self-sufficiency. Of course, diversifying or being dependent on other people for critical minerals, food, energy, even the industrial military complex components of it, or what have you, requires trust. And that's where we come back to this multilateralism without the untrustworthy partners, if you see what I mean. That as geopolitical blocs start to form, they will start to shape the trade relationships, and they already are doing so clearly in quite a dramatic way. So yes, there will be industrial policy, but perhaps there's a shortcut, which is simply ensuring a greater diversity of supply options. So, for example, if a country is monopolizing global trade in a particular commodity, ought there to be perhaps a mechanism by which those exports are penalized so that the second or third most efficient producers can grow market share in such a way as the world is not held hostage to one producer of a particular product or what have you?
All right, we already have a question here from Pierre Majeski. I hope I am pronouncing well your surname. He's asking, Stuart, your biggest concern at this moment in a global scale, and what is your hoping for related to globalization?
So, well, my biggest concern really is that the world has become incredibly dependent on China for manufacturing, and that it's going to be incredibly expensive to ensure diversity of supply in that area. And that although people have been working on this now for a number of years, the immunizing the rest of the world, or those parts of the world that wish to be immunized from that potential coercion, is going to lead to a big loss of economic welfare. It's going to be very expensive. My hope, obviously, is that China can be brought back into the global community as a responsible player, but that will require a change of leadership. And at the moment, there doesn't seem to be a lot of evidence that that is going to happen, because the world will be a lot wealthier and healthier place if that large part of the global population is being led well in a constructive way that is compliant with global norms. And so that would be my greatest hope and my greatest fear.
Thank you. Stuart, Mari Ramirez, she's asking about your view, the way Europe handles globalization and relationship with China.
So I think I think there's a joke in Europe that Brussels foreign policy is made in Berlin, and Berlin foreign policy is made in the boardroom of Volkswagen, and I think that that has had an element of truth running through it in terms of the relationship with China. But we saw that watershed moment, I think, when the comprehensive investment agreement was not ratified after however many years of negotiation, and European parliamentarians were sanctioned by China, and I think that there's Europe is trying to strike a balance between its values, what's good for it in terms of trade dependency, and what's good for it in terms of the prosperity that trade with China in some quarters is perceived to have brought. But in reality, Europe's trade relationship with China is very asymmetric. Germany's been really the only significant country that has struck a reasonably balanced trade relation with China, and even that has taken a big turn for the worse. I think that the Theft of intellectual property is starting to prove a big problem for industry in Germany. The auto industry, their results out of China, I think, have been very disappointing in the last decade or so. Very disappointing relative to expectations. Clearly, as the automotive industry migrates towards the electric vehicle front, China has done its very best to try and capture market share there, at the expense of obviously other producers, and German producers will be amongst those. And therefore, I think that the Europeans do not want to be seen to be simply following a US-led line. But having said that, I think they're rapidly coming to the view that the US and European interests with regards to economic engagement with China are actually very closely aligned. And that therefore, while they might, for political reasons, wish to put some distance between themselves and the United States, in reality, there isn't that much distance between them.
Thank you. I think you're all hearing the Washington, D.C. sounds in the background. It's, I'm not, it's just that too clear. Just want to. Well, Ian Peters, he asks, Stuart, your view, if you see the potential of steps back in the U.S. trade policy to external stakeholders such as China, in the case of a political change in the U.S. and the prospect of Trump's election.
So I think when Donald Trump started to push back against Chinese mercantilism with his tariffs, I think there were some policy mistakes made there in terms of not getting allies on board and various other sort of factors that might have made them more effective. But at the time, there seemed to be a view that this was just Trump, and that, when the Trump regime went, these would go. And then here we are, coming towards the end of Biden's first term, and nothing really has changed. In fact, we've had export controls ramped up. If anything, the ratchet has been turned up on China in terms of economic pushback, policy pushback. And so I suppose the question is, therefore, do you see much changing if we flip back to Trump too? And I'm not sure that we will actually see much change. It seems to me that the United States' appetite for free trade has been massively diminished because of the bad experiences of trade with China, and the deindustrialization that has been a function of globalization. It's sad because the world desperately needs US leadership, I think, in the world of trade. But I don't see a dramatic shift being on the agenda with the change of leadership in the United States, for better or worse. I'm open to discussion about that. It's not a very strong view. It's based of what we saw during the last transition.
Okay, Stuart. John Marinos, he asks about how realistic is a change in China's policy, since a change in the political status quo in the country cannot be seen realistic.
Yeah, I mean, it's interesting, isn't it? Because these sort of changes of leadership in totalitarian regimes, and when I say change of leadership, it doesn't necessarily mean a collapse of the Communist Party rule. It might just mean a different leader of the Communist Party. These changes in leadership always seem highly unlikely until they happen, right? And you tend to find out about them after the event. And suddenly people after the event say, oh, sort of, there was some signs that might be happening. I mean, I don't think we should underestimate how much pressure Xi Jinping must be under in terms of the economic underperformance that is taking place. Because, we are fed a diet of statistics from China's official statistics bureau, which I wouldn't, put a huge amount of store in terms of their accuracy or depicting necessarily the true nature of China's economic performance. Certainly, I think that, levels of youth unemployment, which of course are no longer reported because they're reassessing those numbers, those kind of levels of youth unemployment in urban areas are not necessarily what I would wish for if I was after sort of social stability and harmony. And I imagine those things are going to get worse. Certainly in terms of capital flight from China, and, the best way to measure that is looking at the exchange rate and the lack of foreign exchange reserve growth and what have you. None of that is flashing red, imminent sort of disaster, but it's certainly demonstrative, I think, of weakness in China's economy, severe weakness in China's economy. And so, it's a question of at what point along the road to economic collapse does the regime change, or a change of direction is induced. And that, of course, depends on the pressures that those senior echelons of the Communist Party who are not in power can bring to bear. And obviously, one of the things that Xi Jinping seems to have been very good at is crushing internal opposition so far.
Well, Ellen Haim is asking if you have any input about impact on global trade and globalization wins in the two ongoing wars in Ukraine and in the Middle East, in Israel.
So from a trade and international perspective, the Ukraine-Russia war is obviously more important in terms of the economic ramifications, simply because the two belligerents were big suppliers of commodities to the global marketplace. So that's not a reflection on the seriousness of or complexity of the geopolitical issue. It's just a stark reality of the economic structure of the belligerents. So, I mean, clearly, what the Russia-Ukraine war did was induce, fuel shortages. It highlighted the dangers of dependency, over-dependency on a single source for a crucial input. Something that people shouldn't really have needed reminding of, because that's been there and it's been a lesson learned in the past, and it's important that we do learn lessons from the past. Clearly, China and Russia's newfound friendship, is a function of that war, and China being a hydrocarbon importer, is delighted to be able to import Russian oil and gas at below world market prices. Again, it's to those who wish to see it like this, and I think it's hard not to see it like this, it's a great example of China not acting as a responsible global player. They haven't been alone in that, but it doesn't help, obviously, with maintaining trust between nations, which is what is required for a multilateral trade system to operate well.
A question related to this same subject, I believe. Are sanctions effective, and how sanctions affect the actual global trade?
Well, are sanctions effective? I mean, that's a huge question, and it's not one that you can answer in 5 minutes. But I think the most succinct answer I can give is effective relative to what? Are economic sanctions more effective than war? you know, and I think the answer can be actually yes, you know, because winning a war can be quite easy, but winning the peace can be very hard afterwards, right? And you know, I think there's a sort of consensus that sanctions, economic sanctions, brought to bear to achieve a limited goal, if they can be achieved in a relatively short period of time, those are the sort of, that's the chance of the maximum chance of success. If you set out too ambitious a target for sanctions, then obviously the chances of success are diminished. But if you define success as being, in the case of Russia, and I'm not sure whether this question was linked to the previous one or whether it was just a separate one, but you know, are sanctions limiting Russia's economic progress? I would say definitely. Sanctions constraining Russia's ability to prosecute its war? Yes. Are they making it impossible to prosecute the war? No. But you know, that's not failure necessarily, is it? You know, it depends how you define failure.
Going to another part of the world, we are talking about Russia and the effects of the war in the Middle West. The New South, we look into countries such as Brazil or India. Some leaders, they are suggesting from those places a new way to trade using local currency, or maybe creating a new currency among them to trade. And this is something they are insisting in their speeches very recently. Is this thought far from reality, or do you see that this is possible? I remind that BRICS, for example, they are expanding.
Yeah. So I think it's very far from reality, and let me explain why. So people tend to use the US dollar for trade. They don't have to. There's no compulsion for people to use the US dollar for trade. They choose to. Businessmen choose to. Customers choose to. It's entirely voluntary. So if they didn't want to, they wouldn't, right? So you know, if you look at the number of currencies in the world and you put in place the number of potential cross rates that would exist, you know, with 170 odd currencies, you know, there are 18,000 different cross rates that potentially could exist. You know, what you want when you're dealing in foreign exchange is a deep market so that you get a clean, quick price. You know, I don't know how many, you know, millions or hundreds of thousands of dollars would trade between, say, the Brazilian real and the Indonesian rupiah on a day, but it would be a very illiquid market. And yeah, you might only have to do one leg of a trade, real into rupiah, rather than real dollars rupiah. But whether you'd get a better price or a lower cost, I doubt, because of the volatility that would exist in that cross trade would be much higher as a result of the lack of liquidity in it. So I'm talking here just about trade, not reserve currency status. The second thing I would want when, you know, I'm transacting in currencies for trade purposes is obviously low financing costs, the availability of financing costs. Historically, currencies that are dealt with used for trade and invoicing, you know, usually there's a shipping and insurance element involved in that as well. Sometimes services can be bundled, etc., letters of credit. So, you know, replacing the dollar for these is hard, but it's entirely plausible if people want to do it. But the fact is, because a politician says they want to do it, does not mean that the businessmen who are engaged in doing it are going to want to do it. From the political point of view, this is the other thing that I would point out. You know, if a country such as, you know, Argentina or Brazil or whoever have external liabilities, debts denominated in dollars, they need to earn dollars in order to service and repay those debts, whether that's corporate debt or whether it's government debt, right? So I would question whether you can have this bifurcation between the currency in which you trade, you get paid for your exports, and the currency in which your country has external liabilities. Because if you're going to be paid in Indonesian rupiah for selling them iron ore or whatever it is that comes from Brazil to Indonesia, what are you going to do with it? I mean, I would have thought probably the most likely thing to do with it is sell it the next day for US dollars to repay some of your US dollar debt, or to hold in treasuries as a pool to repay dollar debt, or something. So you know, there's up to a point you can bifurcate the trade transaction invoicing decision from the global reserve currency status, but ultimately the two have a very strong nexus between one another, right? Does the RMB, though, you know, forget maybe trading in your local currencies, but maybe does the RMB start to replace the dollar? Well, you know, China has capital controls, so do you want to really be holding your foreign exchange reserves in country that has capital controls? Now, I know the US put capital controls on Russia for its assets and what have you, and there've been precedences for that. But assuming you're not going to go and invade another country, would you want to have them in RMB? How would you hold them in RMB? I mean, the bond market might be big, but it's not very liquid. It's entirely, you know, are you happy with the credit rating agencies in China and the views that they give you on the bond market? Are you happy that you have access to the right amount of information about what goes on in China in terms of the economy, the state of the economy? Or would you rather invest them in an economy where, you know, there is a critical media who actually offer you analysis and alternatives and views as to what's going on in the economy? There are all sorts of things that go into making a currency worthy of reserve currency status and even trade status. And you know, the other one I would look at is simply this. You know, the dollar has been amongst the best stores of purchasing power of any of the fiat money currencies, you know, since 1971, and we came off the gold standard, right? It's not been the best, but it's been in the top decile. You know, a lot of the countries that are talking about ditching the dollar, you know, are countries whose currencies halve in value against the dollar every 5 years, right? You know, I mean, the Argentine currency, the Brazilian currency, the Turkish lira, the South African rand. All these currencies, if you go back and look at what the exchange rate was in 1971 when the dollar came off the gold standard, or 73 when it came off the international convertibility for gold was abolished, and look at how these currencies have performed against the dollar since then, what's noticeable is that they're all worthless against the dollar, you know, over that period, a 50-year period. And so it sort of seems odd to me that people are saying, well, we've got to ditch the dollar because they abuse the dollar's money, you know, too much money printing, too much QE. And that's coming from, you know, politicians from countries that have overseen the complete debasement of their own currencies. That doesn't really add up to me. I don't think the private sector in those countries are necessarily going to swallow that view.
And a final question, if possible. You have spoken so much with us. Thank you so much. A lot have been said here at the beginning about trust, lack of trust, and the need of trust for business around the world. Do you see a good future for the WTO with a lack of trust regarding global market?
Well, I think that the WTO might have its work cut out to reassert its authority, and really, at the end of the day, it needs leadership, and it needs the United States to be an active participant in it, a constructive participant. You know, without that, it's very hard to imagine that the European Union can lead WTO on its own. I mean, you know, so. It's the middle powers of the countries that really need trade the most. They're the ones that benefit it from the most, not the European Union, the United States, or China. It's actually Japan and South Korea and the United Kingdom and Australia and Brazil and, you know, India, Indonesia. These middle powers are the ones that really need it. And those that are committed to pushing forward trade reform and deepening international engagement, I think will join plurilateral organizations that facilitate that in new areas like digital trade and what have you. And so far, I think the CPTPP seems to be the area, the organization which people are leaning towards. There are no superpower members at the moment. And I think that organization has tremendous potential to grow and to pick up the agenda if the malaise in the WTO continues as it is.
Thank you so much. I spoke today with Stuart Patterson. He's a research fellow at the Hinrich Foundation. Thank you so much, Stuart. Thank you.
Thank you, Patricia.
Well, thank you for your audience. The paper that Stuart prepared is available in our website, at the website of the Association of Foreign Press Correspondents Association. If you dive there, you can find the full content. Thank you very much. This is a program, an educational program developed in partnership with Hinrich Foundation. Thank you all. Have a great day.